So let's take it back from stocks back to the bond market here, because the last few days have shown the impact that any sudden moves in the bond market can in turn have on stocks. In the next few days, a fresh supply of debt is going to pose new questions. One of the things that we have talked about throughout the week is that, with this downgrade, perhaps one of the reasons that it is more muted now perhaps than it was in 2011 when S&P downgraded U.S. debt, maybe in part has to do with the huge supply that is out there in the U.S. Treasury market. But it can be sort of a headwind. I guess it can be a dampener, but also can be a headwind at times.
Yeah, it's tricky, and there's a lot of nuance here. So I have a couple charts prepared. Let's pull up the Treasury debt, the issuance chart, to just show you there's been a huge spike. If you'll recall, recently we did have a debt ceiling debate, and here's Treasury sales. This is over the pandemic. This is when, I can't annotate on this, but this is when we issued all that debt in response to the fiscal needs at the time. You can see we have ramped right back up here, and that's because into the debt ceiling debate, the Treasury could not issue debt. It was up against that ceiling. It's playing a game of catch-up here, and this has happened. Now, the Treasury has issued roughly $852 billion of bills on net and plans to raise another $53 billion next week. So issuance across the board is rising here. And I have a couple of numbers here. $67 billion in 3-month bills. That is $2 billion more than they were offering before. $60 billion up in 6 months from 58. The list goes on here. So Treasury issuance is going up, and then you have the debt downgrade. And let's pull up the yield curve chart so I can show you what's happened with respect to the U.S. The yields on U.S. debt. Here is our last. So the purple line is the current quote, and then here's where we were 1 week ago, that cyan line. We have really risen on the long end of the curve, especially on the 30-year. We're up 20, 30 basis points, a huge move there. That puts pressure on debt. So if the yields are going up, that means people are selling the longer-term debt. Maybe they were spooked by the Treasury announcement or the debt announcement that they are downgraded. Also, you take a look at what's happening in Japan. That is a huge factor. If we can give me the Wi-Fi interactive, and I'm going to go back to the 10-year. This move right here, what really got the Treasury market started, yields punching to the upside one more time to 4%, that was Japan. That was the pseudo-abandonment of yield curve control. So I think that's a huge factor because they are only at the beginning of that. If the Japanese investors can get a higher yield in their own country, their home country, they don't need U.S. dollars. They don't need these treasuries. So everything's kind of coming together on that front.
And one more thing I would mention here, and this is something that Mohammed El-Arian talked about when we talked to him earlier in the week, that I think is a great point. Everything's relative when it comes to, it's not relative as much when it comes to stock markets, right? But in the bond market, in the currency market, it's all relative. So in other words, you look at the U.S. versus Japan when it comes to currencies, for example, in other markets, and many investors still judge the U.S. as a place that they want to be.
Yeah, I mean, most currency movements can be described and can be represented by two things. You have yield differentials. Right now, the U.S. is offering some of the highest yields in the world, and so that makes people want to buy our debt. To buy the debt, you have to buy U.S. dollars. So people rush in, you see the U.S. dollar go up, and you also see yields stabilize or maybe even go down because of all the interest in debt. And so that's the theory there. In terms of stabilization, I think the argument for the overall risk market picture here, why does the bond market upset equities? It's because it's highly leveraged. And if you have a big movement in the bond market, that means they get big banks, which are the biggest holders of these debts, and also hedge funds, they get skittish and they don't have as much money reserved for other things. And there are government regulations that really restrict the ability of banks to be able to buy these other risk assets. So it's all intermixed. And then you take into consideration what the Federal Reserve is doing. They are still engaged in quantitative easing, which is actually shrinking the balance sheet. So that just puts more incremental pressure on the need to sop up this cash, and that's what's being done right now. There's a lot of money sitting at the Federal Reserve that can be used for these debt purchases, so it's not a dire situation just yet. But we could get to this stage, and we're probably approaching there where it's going to be affecting the markets, so it's definitely something we need to keep in mind.